Hi, and welcome to your weekly macro roundup, where we talk macro and try to make sense of markets that really don't make any sense. I'm your host, Steve Van Meter, and thanks for joining me today because we've got to deal with the elephant in the room. China is dumping bonds. That means interest rates have to be going through the moon. Steve, your thesis is totally annihilated. It's busted. Throw it out the window. And yes, I got messages and emails. Oh, your thesis is trashed. It is no good. It is busted. And yet, you know what's interesting to me is no part of my thesis, not one piece of my thesis had to do with China buying U.S. treasuries. Not one. Has nothing to do with it. And I thought, maybe after Wednesday people understood it more, but I'm guessing that possibly they don't. So let me quickly review my thesis in terms of what it would take to break it. And then we're going to discuss this whole China bond thing because it's not what you think it is. And it's actually been going on for a while now. So my thesis is grounded on the laws of our monetary system, or what's known as the Federal Reserve Act. So one way my thesis could get broken is if Congress passes a law. It doesn't mean there's a bill. Has to be actual law passed that repeals specific parts of the Federal Reserve Act that would allow the Fed to print money. That has not happened. Another way my thesis could be busted, but not in entirety, but would actually go a long ways, is the Fed would have to stop doing quantitative easing. They're not going to stop doing quantitative easing. Fed Chair Powell has made that clear that we are going to continue to do quantitative easing at the current rate of $120 billion per month until we see inflation over their 2% target. Well, that hasn't happened. So that's not gone away. We have to see lending growth return. That's not happening, and we're going to look at that today. That's why the Friday data that is so critical. It's just you have to see what's going on in the lending market. We'd also have to see banks loosen lending standards, and they haven't done that. They're as tight, almost as tight as they were during the great financial crisis. And or pick this one too, the dollar would have to go away as a world reserve currency. Now, last I checked on that list, China was not there. So what's the deal with China? So the state media announced that they were going to gradually, keyword, gradually reduce their treasuries from $1 trillion to $800 billion. They did not say over what period of time, and the media and financial people turned into China's dumping bonds. It's over. It's all over. Interest rates are going to the moon. And yet that news broke after market close, or maybe before market close yesterday. And for the most part in the overnight market, treasury yields didn't budge. I mean, they went up a smidge. It wasn't until markets opened this morning that they went down. Because what people don't understand, there's several things people don't understand. One is China has been actually gradually reducing its treasury securities for at least the last year. Here is the major foreign holders of treasury security, or TIC data. And let me make it a little bit big for you. Here, China mainland, number 2 on the list, has gone from 1.112 trillion down to 1.074 trillion. So if my thesis has been busted by this article, then how come it hasn't been busted over the last 12 months? Because interest rates are down over the last 12 months, and that doesn't make any sense if it's a thesis busting deal. Well, it's not. So let's talk about how a country like China gets dollars, right? So they have bonds. How did they get those bonds? Well, what did they do? They exchanged dollars, right? They had dollars, and they swapped those dollars. They went to a treasury auction, and they bought bonds. Where did they get the dollars from? Did they conjure them out of thin air? Did they win the dollar lottery? No. They get it from global trade. Because when a ship from China lands at U.S. port, do we pay them in yuan? Any of you who are in the import business, do you pay your import costs in foreign currency? No, you pay in U.S. currency. That's what the dollar, being the world's reserve currency, is all about. We pay bills in dollars. So that company that imports those goods and services gets dollars. Now, granted, they do need some of them, maybe to buy other commodities or things, but they can't pay their employees and their other bills in dollars. So they take those dollars that they don't need and they go to their bank and they convert them for local currency. Now the bank builds up some dollars and they do dollar denominated loans. As far as we know, there's an excess of $10 trillion of dollar denominated loans in the global economy, which would mean outside the US. Now when those banks build up too many dollars, they go to their foreign central bank and they swap those for local currency. And when they pile up at the foreign central bank, when you get enough of them, they become inflationary. And so to tamper the effects of inflation, they take those dollars and they switch them to a treasury bond, which pays a small amount of dollars every year, or a dividend. That's the whole cycle right there. So when the global economy is expanding, when there is inflation, that is when foreign central banks are buying bonds. When they need dollars, they have a reserve of treasuries. They have to sell them to get dollars, because what's going on behind the scenes? Well, you have businesses that have dollar-denominated loans, and there's a dollar shortage. And if the global economy isn't expanding enough to meet that need, well, then there's a demand for dollars. And to get those dollars, the foreign central banks have to sell treasuries. That's their savings account. In fact, if we look at this, the tick data, you can see that roughly over the last 12 months, the global economy's only bought 400 billion more bonds, not a whole lot. There isn't a demand because there's a dollar shortage. So when you see foreign central banks selling or significantly reducing their pace of purchase of treasuries, it's because it's a sign that global economy and the global trade has slowed down. There's a shortage and we are experiencing deflation. So they buy during periods of inflation, sell during periods of deflation. So it doesn't bust my theory at all. In fact, it supports it because it's telling me what I already know, is the global economy is weak and there's deflation going on. And had that article, right, that hit the Chinese state media, had someone in the U.S. picked it up, instead of just, exaggerating it to say that they're dumping treasury, said, hey, XYZ hedge funds are going to buy $200 billion worth of China's bonds when they sell them. Because do you know what China's going to get when they sell those bonds? Dollars. That means somebody with dollars is going to buy them and wants to make that exchange. But the attitude that investors have is, oh, nobody wants these things. China's getting rid of them because they don't want them. No, they're getting rid of them because they need dollars. They need dollars. All right, so I want to tack on to that. And I'm glad that most of you got this, but I did misspeak in Wednesday's video when I said that there was a cost, a borrowing cost, and I misstated that. Most of you understood what I meant. But these reserve accounts from the QE, right? So when the QE process is done, a bank gets a reserve asset that pays the bank 0.1% per year. And I said the borrowing cost, and I didn't mean that, but most of you understood what I meant. I meant the opportunity cost for the bank is they have to go out and lend money at a rate that would make them more than 0.1% a year. And they don't want to do it. They feel the risk is too high. That is really thought-provoking. And you think about what the banks are telling us about the economy right now, they're telling us it's really weak. Now, a lot of people have questions about, well, stimulus, isn't that inflationary? Isn't the TGA inflationary? Isn't the PPP loans inflationary? Isn't anything possible that I can dream up inflationary? Oh, the government borrowing more money, that's got to be inflationary. So the government's been borrowing money for 40 years, and where's the inflation? Not there, right? So we got to look at what the facts are. The government can continue to borrow large amounts of money and not create inflation. Because what is inflation? It's the creation of currency. How does currency created in our monetary system? Through the banks. So if I receive a stimulus check and I use it for living expenses or to debt service, it's not inflationary. It's not inflationary at all. I'd have to use that money to borrow, maybe as a down payment or collateral, to borrow money to go spend on discretionary goods and services. Now, back under the Reagan era and the years around that, we got away with borrowing being stimulative because we had a small amount of government debt relative to the size of the economy. But the larger the amount of government debt, Stimulus can be inflationary, but if it is, it's transitory because all this borrowed money has to be repaid, including any notion that there's going to be UBI. And there's probably not, because the government can't sustainably borrow all of this money. They just can't. It's not possible. All right, and then the last question that came up is, oh, and many of you have said, hey, Steve, we already kind of know that QE drives interest rates down. That's really cool because most people didn't actually know that. The market's view is QE causes rates to rise. We've now settled that. And the only way QE leads to, say, an increase in the M2, which is a lot of people, and I know, Chris Dark, you're saying it's not the only way, and I know that's correct because you've got the answer. But generally, QE does not lead to an increase in the M2 without lending growth. It is possible, but it's not a substantial increase at all. And the last question that came in is, why are banks doing QE? Why would they agree to this? I've got some opinions on that. I'm just not ready to put them into a show because I'm working on keeping these down to 15 to 20 minutes. Let's take a look at the assets and liabilities of commercial banks. See if there's lending going on. That's why this is so important. Fridays was one of the most important macro days, and too many people don't even know why it's important. Look, treasuries, securities, and bank credit increased, but nobody wants bonds, they say. Well, apparently there was $22 billion of treasury and agency securities bought, $4 billion of mortgage-backed securities, all the rest. So that would be $18 billion of non-mortgage back, or what are actual treasury securities. Week ending August 26th, and of course, remember, everyone said, oh, look, there's Steve's wrong because the yields are going up. And I said, don't worry, the banks are probably buying. I have a hunch. Here is the week ending August 28th. Right in here, that means the banks were buying $18 billion of treasury securities as everybody was selling. Not a shock at all. Loans and leases, all commercial banks up only a billion. That's pretty small. Commercial industrial loans down $2 billion. Not a lot going on here. Real estate loans, let's see, commercial or residential up $1 billion. Nothing going on there. Commercial real estate, a shock that anybody would, somebody's going to be a bag holder on these commercial real estate loans. Fortunately, not me. Up $3 billion there. And consumer loans dead flat for the most part. Credit cards down slightly, $500 million, nothing really going on there. So nothing really interesting here other than there's really no growth that last week. And that is, of course, long-term a problem. Let's go into the M2. Now, the 12-month rate of change is slowing down, 23.08%. 6-month rate of change is falling. The 3-month rate of change is falling. And I've said that I believe the M2 is going to fall without stimulus because people are going to have to tap into their savings accounts. Now, let's go and look at the M2 and see what we find. Savings deposits down over last week. M1, which is mostly demand deposits, that was up. So we saw some money moving in there, and institutional money funds down. The overall M2 fell. So by, not quite, let's see, I'm trying to look at this. Looks like over 100 billion. Yeah, 140 billion. So it was down. But I think I did the math wrong on that. I know many of you will correct me, but hey, we're live, we don't edit. And it's hot here. The monetary base is up the monetary base didn't change. This is updated every 2 weeks. So here's another thing that people totally get wrong. And when they say that Steve's thesis is busted, is the money multiplier went down because the M2 went down, and we presume the monetary base is rising because of the Fed's QE, and a rising money multiplier suggests inflation. A falling money multiplier is deflationary, and that's why, my friends, the crown is back on. That's right, the crown is back. Okay, let's keep going here. The real estate loan growth, the year-over-year rate ticked up to 3.65. Not a big difference considering ultra low, near record low 30-year mortgage rates. The 6-month rate of change has fallen. The 3-month rate of change ticked up slightly. So not a lot of activity here. Commercial industrial loans year-over-year increased slightly. 6-month rate of change is falling. 3-month rate of change improved slightly to minus 6.58%. That's not good. Total loans and leases on all commercial banks Again, year-over-year rate increased slightly to 6.42. Recurring trend here, 6-month rate of change falling. 3-month rate of change improved slightly to 2.3. No lending growth. No economic recovery, no higher interest rates. How about credit card loan growth was flat at minus about 9.11% from a year ago. No V-shaped recovery from that at all. So now you kind of see that the lending growth data is super, super critical to the big picture. So let's go take a look at some charts. I haven't had a chance to look at too many of these since market close, but we see today interest rates went up. And once again, Steve's thesis is busted. Here come higher interest rates. Clearly, we know the banks are wanting to buy because we've seen them over the last 2 weeks adding Treasury securities. You know, anyone who says there is no demand for Treasury securities is pretty baffling, considering, you know, if you look back, yields are way down here. Way down here. Yeah, that's what no demand looks like. If there was no demand, yields would be way higher. S&P 500, everyone got freaked out now. Market was down 2 days in a row. It closed giving back what? Its gains from 821, which was what? That was 2 weeks ago. So the market gives up 2 weeks of gains and everyone freaks out. What they really should be watching for, I guess, see, I didn't look at that. The VIX broke 31. Remember I told you if the VIX starts breaking 31, things get interesting? I didn't think it was up that high. And there you go. See, I told you I didn't look at the chart. So it broke 31. Things got sketchy, took off, reconfirmed the top of it. This is interesting. If the VIX can't get back down here under control, maybe we start to see an unwind. Who knows? For sure, taking a look at gold mine stocks. Again, I've been saying when the dollar rallies, this is going to be a peak. A lot of people disagree with me. That's fine. That's what markets are for. How about energy stocks? But you didn't hear in the news today that ExxonMobil is laying 10% of its global workforce off. And, you know, everyone thinks that's bearish for energy stocks. I don't. But looking at XLE, I mean, it tells me that if these large energy companies are cutting their employer match on their 401ks and they're getting rid of employees, it's not because they think oil prices are going higher. So again, we see this continuation of a topping pattern in the broad energy ETF. Looks like it's headed lower. Financial stocks seem to be moving opposite treasury yields, and they indeed are, but this still is a topping pattern until otherwise proven. We've seen pretty heavy resistance up here. We'll see if that breaks down into next week. How about emerging market stocks? They broke their upward trend line. That could be an ominous sign of what's coming, because remember, emerging markets tend to lead here, and emerging market stocks need to rise to validate the higher price in gold mining and gold stocks. But we'll see, because emerging markets comes down, gets to the line of doom. Whoa, boy, bad things coming there. How about the dollar? Still, remember here, people, Steve, your dollar bullish theory is busted, and then it came back up. Look, I'm still macro bullish on the dollar. As there is still a dollar shortage. The dollar shortage is not going away. And as more people have to start paying on their bills and have less income to do it, guess what? The dollar shortage is going to get pretty obvious. And how can we end without taking a look at bond prices? So we see that the Treasury bulls drove the ball back to the 35-yard line, where the Bears, maybe there's a fumble here. We don't know. We'll see. Maybe the Bears defense was rested up and really ready for some game and pushed them back down into this very strong zone where the buyers have been. What will happen next week? Don't know. But the overarching picture of the macro thesis is that everything is going on is bond bullish. When this gets through this line of support, this dotted purple line, you can see the sellers were pretty aggressive here, but they're defending. They get through here, you're back up in the 170, get through 172, and the sky, my friends, is potentially the limit. Be sure to like, subscribe. I try to get to as many comments as I can. I really, really do appreciate them. Gives me an idea of what questions I need to answer, but more importantly, I hope you have a great holiday weekend. For those of you who do not have a holiday weekend coming up, the show will be back on Wednesday, so I'll see you then. Thanks for watching. Bye now. The content of this video is provided educational information only, is not intended to provide investment or advice. Shows not to be construed as a recommendation or solicitation by selling security, financial instrument, or participating in particular trading strategy. This video was prepared by Stephen Van Meter. Personal capacity of business expressed this video that I do not reflect the view of Atlas Financial Advising or Stephen Van Meter Financial.